Welcome everyone. My name is Gretchen Schmitz and I'm with Transition Advisors. Our webinar today is Preparing Your Firm to Grow Through M&A. Before we begin, we need to cover a few very important items. First, please close all other programs running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors, LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order to receive your 1 CPE credit, you must complete 2 requirements. First, you must participate in 3 of the 4 polling questions throughout the presentation. Please note that GoToWebinar does monitor your participation. Next, you must complete that will appear on your screen immediately after the end of the webinar. Please do not close your browser before completing this survey. Once these requirements are met, the certificate will be emailed to you within 10 working days. In order to fully participate in the webinar, please familiarize yourself with your GoToWebinar control panel on the right-hand side of your screen. The orange arrow on the top of the control panel is to minimize the control panel. During the presentation, all participants are muted, but you can communicate with us by using the question box towards the bottom of your control panel. Just type your question in the box and click Send. Questions are important to us and we would like to address your concerns. Time permitting, our presenter will answer all of your questions. Finally, I'd like to remind you that Transition Advisors offers 2 free 1-hour CPE webinars each month. Our upcoming topics include the art of your deal, partnership agreements, new practice niches, and preparing your firm for an upstream merger. For a complete list of webinars, including links to registration, visit the CPE courses section of transitionadvisors.com. As a reminder, you received a link in the reminder email to download a copy of today's presentation. I sent the same link just now via the chat function of GoToWebinar. If you would like a copy of the presentation sent to you by email, you may send your request to our Marketing Director, Nikki Johnston. Her information is on the screen, or you can reach her by replying to the emails you've received from GoToWebinar. Now I would like to introduce our presenter for today's session, Terry Putney, CEO of Transition Advisors. Thank you and enjoy the webinar.
Hello everybody. Just a quick update. You're going to find that there's a few slides in this presentation that are slightly different than the links that you've been provided. I don't think it'll make any difference to anything that I talk about. So, but if perchance you want an exact duplicate of what I'm presenting, we're happy to provide that. Just let us know by email. I kind of undermined Gretchen with some last-minute changes here. We're a national consulting firm. We focus strictly on CPA firms. We work strictly with ownership transition issues. That falls into 3 kind of main categories. One would be kind of overriding all of that to a great extent is succession planning, both with respect to internal and external succession. That sort of leads to the work we do with mergers and acquisitions. We arrange and help structure and negotiate and document, so forth, mergers and acquisitions. And we also work on designing and structuring owner agreements for CPA firms. Today we're going to talk about, obviously, the M&A side of what we do. Let me start off with a recent case study. I've changed the names to protect the innocent, so to speak. Dewey, Counham & Howe is a 5-partner, 35-person firm. They were interested in acquiring a practice to spur growth so they could make room for some new partners. They sent their managing partner, Mark Howe, out to find candidate firms. Mark found John Goodguy, who had a $900,000 practice looking for succession. Mark had read our articles on 2-stage deals and attended a couple of our webinars on valuing an accounting firm. And as a result, he negotiated a deal structure with John based on a 2-stage deal concept. And the deal terms are basically that they agreed to were John would work 2 more years and earn his current level of compensation. He'd slow down at the end of that 2 years to less than to at most 400 hours and possibly not continue working at all. He would keep his accounts receivable and WIP, and he'd be paid 20% of collections for 5 years, which wouldn't start until after he slowed down. There's obviously a lot of details I've left out here, but that was generally the concept of what they agreed to. Mark told John that he had to go back and get approval from his partners, but he didn't anticipate that being a problem. However, when he went over the deal with terms with his partners, he got a lot of pushback. First, they felt like replacing John's accounts receivable and WIP was going to create a negative cash flow, which of course it would, and they were not willing to finance that. They weren't willing to take a cut and pay nor go to the bank to borrow the money to do that. They estimated the cost for technology, moving John's practice, and training his staff would cost about $50,000. They weren't willing to finance that either. At $350,000, which is what John was making on his practice for 2 years, John would be making more than 3 of Mark's partners, and they would not agree to allow that to happen either. So they sent John back, or Mark back, with, revised terms. And these terms were: John doesn't get to keep his AR and WIP. John takes a $50,000 cut and pay the first year to help pay for the cost of the moving, training, and technology. And John's response was, "Would you like a bow around that gift you're asking me to give you?" Needless to say, the deal didn't happen. The lesson in this tale is really that Dewey, Counham, and Howe was really ill-prepared to pursue mergers and acquisitions. Today we're going to go over these items, which I believe are important to preparing your firm to pursue mergers and acquisitions in the marketplace. First polling question, Gretchen, I'll turn it back to you, get an idea of who's on the line. Gretchen? Excuse me just a second, please. Let me know when you're back on. A technical problem here, so I'm going to go on. We'll come back to that polling question. First issue is, your business plan.
There.
The number one reason why, are you there, Gretchen?
I'm here.
Can you get the polling question up?
Yes, I can.
Okay.
Sorry about that.
Let's go back. All right.
Okay, the first polling question, I apologize for that delay. How many equity partners do you have in your firm? Your choices are 1, 2 to 4, 5 to 9, 10 to 19, or 20 and more. Just another few seconds here. Okay, we'll go ahead and close this question. And your responses are 1%, or 1 is 37%, 2 to 4 is also 37%, 5 to 9 is 15%, 10 to 19 is 7%, and 20 plus is 4%.
Okay, thank you. All right, so the number one reason why we find that firms are pursuing acquisitions in the market is just to spur on top-line growth. One of the things I think that's overlooked is the importance of growth for internal succession. Virtually every firm that's on this call is eventually going to face, if they're not facing it right now, some succession issues within their own firm, even if they do consider themselves to be an acquirer. And the firms that we find that successfully can sustain themselves long-term are firms that are growing. And the reason why is because that makes room for new partners. And without new partners and without a constant flow of new partners, you can't obviously sustain yourself. Some of the other reasons, though, why firms would pursue growth through mergers and acquisitions are: 1, to acquire new partners, feeling like we need to strengthen our current level of the partners in our firm with additional partners. One that's really key with most large firms is new geographic markets. Most of the large firms we work with have target markets in mind that they want to expand into. They basically have a map in mind with holes in it that we'd like to fill those holes. Sometimes we're looking for new service lines to add to a firm. Let's say, for instance, that they see they see within their market or client base an opportunity to provide a certain kind of consulting service. We might be looking for a firm that has that provides that consulting service. What's even more popular are looking for clients to cross-sell existing service lines to. A big one there is wealth management. Most of the large firms we work with nowadays have wealth management practices, and it's definitely attractive for them to find firms that have clients they can cross-sell those services to. And in some cases, it's a matter of just looking for general talent, although I will tell you that that is usually a wish list, and it's very hard to fulfill that list, because firms that have that kind of available talent typically are not looking to merge upstream. It's possible, and it certainly can be frosting on the strictly in mind. You know, when should you be using a merger versus when should you be buying a firm? Generally, we believe that the rule of thumb on this is to use what I call the 5-year rule. If the firm you're acquiring as partners, our partner, let's say we're dealing with a sole proprietor, is going to stay with the firm for less than 5 years, then it's most likely the best opportunity is generally to look at an acquisition as opposed to a merger. On the other hand, are going to stay for 5 or more years, then generally a merger is probably more appropriate. Oftentimes we have a combination of those two. So we might, let's say we've got a 5-partner firm. We've got 2 partners that are wanting to get out in less than 5 years. For those partners, we might negotiate what in effect is an acquisition of their part of the practice, whereas the other 3 who are going to stay longer than 5 years would most likely be merged in. The reason for this is that partners that are not merged in are basically going to, even though they may stay on and be called a partner for a transition period, are basically in a contract status, which means that almost everything you do with them is defined by the contract and is probably an exception to your owner agreement and policies for your other partners. The longer you're in that status, the more unwieldy the situation becomes, and so that's the reason for the 5-year cutoff. You also don't want to have a partner typically come in for 2 or 3 years, you know, have to buy equity, become part of your owner agreement, you know, deal with all the uncertainty that goes along with that. It's hard to oftentimes sell that to somebody who's basically a short timer. One of the issues that we find, and this is the best example, was the first case study that I talked about, is a failure to understand the resources that are necessary to do a merger or acquisition. You know, when you deal with the deal terms, we're talking about there's certain costs that are going to be incurred at certain times, obviously as the purchase payment. So is there a down payment? You know, what are the term of the payments? How long are we going to make additional payments over? What's going to be the tax treatment and so forth? You know, how much working capital are we going to have to employ to acquire the firm? You know, what technology investment are we going to make? I mean, it's very rare that the computers and other technology that come with an acquired firm are going to be useful to your firm for very long. So what's it going to cost to replace all of that? You know, what are the cost of facilities? Are we inheriting a lease? Are we able to move this firm into our existing space? Do we have to build out new space? You know, what are the cost of, what's the cost of training? And then what synergistic costs can we incur or can we create? Depending on the size of the firm that you're acquiring, the synergistic cost could be extremely high. If you're creating, if you're combining the firm with your existing offices, we find that the synergy can run as high as 15 to 25% of the revenues of the firm that you're acquiring, basically because you're eliminating redundant costs in their cost structure. If you're going to be creating a new office, oftentimes we still think that you can find between 5 and 10% of the revenues of the firm you're acquiring in synergistic costs. Now, of course, this does not count any kind of build-out costs. So if, for instance, you don't have the space available to move the firm into and you have to build out new space, then you're going to have to reduce those cost savings by whatever that new space costs. Keep in mind that, you know, before any purchase cost, I mean, the down payment, my rule of thumb is that you're going to spend about 30% of the volume of the acquired firm on working capital, and other types of costs such as technology and training. It's one thing I find that don't understand, and it's clearly what Dewey, Counham, and Howe didn't understand was that there would be a cost incurred up front. They weren't prepared to provide those resources. Another important issue is aligning your partners. Finding out who are your decision makers. Obviously, if you're in a small firm with 4, 5, 6 partners, probably all of your partners are decision makers. If you're in a much larger firm, then you're probably dealing with an executive committee or a board of directors that will be your decision makers. But I think it's important to go through, before you undertake the process of looking for acquisitions and mergers, go through all the different things that you're likely going to run into. So going back to the previous slide, what kind of required investment are you going to have to make to finance deals? How much capital are we going to have to come up with, and where are we going to get it? How are we going to deal with partner compensation that we're going to run into? Let me give you a couple of examples. These are real examples. I'm still working with them, working with a firm that happens to have very low profitability per partner. I'm not going to get into why it's that way. It just is. In this case, it's a pretty good sized firm with, I believe, 13 partners, and their average net income per partner is $225,000. As we went through a potential acquisition for them, it had actually been a merger. They were merging in a young partner, sole proprietor, who was in his late 40s, who had a practice that was generating roughly $300,000 a year in profit. And as we went through the process of evaluating it, we found that a majority of the partners in the acquiring firm were unwilling to pay this person more than they were making. There's no reason for that in my mind, but they just felt like it wasn't fair that he'd be making more than they would when they were already partners. Well, needless to say, what I had to tell them was, what you're basically saying is, we need to find a firm that's either being run as you are at a low profit margin, or we need to find firms that are small enough that their profits are so small that they'll fall into this criteria that you've created. In my mind, it was a bad decision, but the fact is they didn't have this discussion until after they'd already gotten into a real deal, and it killed the deal. Another example similar to that is a firm that we work with whose profit margin is a low percentage of volume, even though the volume managed per partner is fairly high. So in this case, we brought to them a potential merger where the compensation of the partners would be in the range of about 35% of volume, which is pretty normal for most practices. In this case, though, their partners are making about 20% of their volume, and so they were having a problem with, well, if they're not managing as much business as I'm managing, and they're making more than I am, how do we work that out? In that case, we were actually able to overcome that problem with them and got them to understand that was a poor way to look at it. But again, it's better to have these conversations ahead of time. Equity is another issue we run into. Oftentimes, this is nothing more than a beauty contest. The most important thing is to find out what does equity really mean in your firm in the case of a merger. So we're talking about how much equity do we allocate to the firm that we're acquiring. If, what I run into sometimes are firms that are looking for some kind of a premium in this allocation for themselves to say, look, our volume, our profits, our partners, our clients are better than yours, and therefore we should get more equity on a pro rata basis than we're willing to allocate to you, which of course sends a pretty negative message to the firm you're trying to acquire. But the most important issue here is to understand what equity really means in your owner agreement and how it's really going to affect the partners that you're merging in. Client mix, you're always going to run into clients in acquired firms that you don't want. There's never going to be a perfect match. And being ready to understand at what point does this indicate this is a firm we should not acquire, and at what point should we be trying to accommodate the clients that they're bringing to us that we wouldn't have otherwise ideally wanted. Demerger clauses come up frequently. A demerger clause would be a situation where the two firms could say, look, at some point in time, under certain circumstances, we can unwind this deal. Many of the people we work with want them. We think they're a problem. We should try to avoid them whenever possible. And the reason for that is because a demerger clause in essence says, what do we do if we get divorced? It typically means how do we split up the assets that we combine, client base, staff, and so forth. And because people want to protect themselves in order to put themselves in the best position if that does happen, a demerger clause in effect means that or can cause us to not integrate as well as we would have because we're really holding back. We want to make sure we keep our assets and we want to control those assets. We don't want our clients, for instance, saying, gee, I really like this new firm, so I'm going to stay with them. So what it actually can do is actually can create the problem that leads to the demerger because we have a poor integration. So if you're going to have a demerger clause, then you should have one that's probably limited to as short a period of time as possible. We try to keep them at 1 year or less. And again, we try to talk firms out of actually using them. But understanding that beforehand, because it seems to always come up. And then understanding the difference between acquiring talent and versus buying a business. I've run into examples where we have to go back to this situation where we have this young partner that was merging his firm into this other firm. If this person had walked in off the street with the talent that he had, they'd kill for the opportunity to hire this person, knowing of what his capabilities were. But sometimes we get caught up in what's the deal, forgetting what the talent acquisition is, and we're not willing to be flexible about the deal terms, taking into account the opportunity that the talent is bringing us. So again, being prepared for what you're really trying to accomplish. Assessing the market. Is it a buyer's market or a seller's market? I almost always get that question when I do presentations live. It's a buyer's market wherever you have an imbalance in the number of buyers and sellers that's in favor of the sellers. In other words, there's more sellers than buyers. So what can cause that would be a location. If you're in a small market, or if the seller's in a small market, where there are very few buyers available. Mid-sized firms are finding that the number of sellers has increased in mid-sized firms enough, and because the buyers are limited because of size, that there's becoming an imbalance in many markets with respect to mid-sized firms. And the other thing that's surprising to a lot of people are niche firms or specialty firms also run into this issue because a niche firm or specialty firm is going to find many fewer buyers than a normal firm would have because of their niche or specialty. Oftentimes they have to take what they can get. A good example would be a litigation support practice. They're very hard to find buyers for. And certain other types of specialties that requires industry concentrations and so forth. Where it's a seller's market, large metro areas, due to a plethora of buyers, the best example is New York. The whole New York metro area. There are thousands of potential buyers for many practices. In the Nassau County alone, there's something like 2,500 accounting firms. Not all of them are buyers, but you can find many, many buyers for most practices of a reasonable size. So in a market like that, it continues to be a seller's market. Also, in most places, smaller firms that can be acquired with little to no incremental overhead because of the terms that are used to acquire accounting firms often can lead to a buyer or a buying frenzy against those firms because of the opportunity they create. When you prepare yourself to go into the market, make sure that you understand what the motivations are of the sellers. Most sellers nowadays are looking for succession. And also keep in mind that all sellers have a problem they're looking for you to solve. So just be aware that, gee, this is something that this seller is bringing to us, a problem we've got. Well, that's why they're talking to you in the first place. With competition, try to find out as much as you can about who you're competing against and what they're doing in the marketplace. There's very few markets that don't have several firms that are active in their market looking for acquisitions. Most sellers are talking to more than one firm, and if they're not talking to more than you at the time, if you wait long enough, they probably will be. what are the trends in valuations? We continue to see a basic expectation for most sellers to get 1x revenue somehow. In a market like New York or other markets of that size, there's still an expectation to get more than 1x. We're not seeing some of the crazy multiples that we saw, maybe 5, 7, 8 years ago. But certainly there is most sellers come to the marketplace with that expectation. At the same time, we're seeing an increasing amount of buyers that have an expectation to pay less than 1x. So there tends to be this imbalance between what the seller's expectations are and what the buyer's. Now, of course, if the seller's desperate to sell, they're going to sell for whatever they can get. But in most cases, that's not the case. But the thing to keep in mind is there's actually 5 components of deal terms that can have an effect on value or an effect on the multiple. And those are, first, the amount of cash up front, if any. That can happen because of a down payment. It can happen because of the way you treat accounts receivable. It can happen because of the time of year the deal closes. The more cash up front, obviously, the more costly it is to the buyer. How you treat the retention clause, client retention clause in the agreement can have an impact on the pricing. So, for instance, a deal that's a full collection deal over, say, 5 or 6 years, which is very favorable to the buyer, compared to a deal that has a very short retention clause, say only 2 years, should have an impact potentially on the pricing. The profitability of the practice, and we're seeing this being even more the case nowadays than it used to be, where the margin of the historical margin of the seller is being taken into account in the pricing. In some firms, it drives the value completely nowadays. They're only willing to pay a certain multiple of profits for the firm. But the profitability of the firm certainly can make a difference. And really, when we talk about profitability, we're talking about the profitability in the hands of the buyer, not so much in what it was historically for the seller. That's certainly a guide. But in some cases, a practice will be more profitable for one buyer than it will be for another buyer. And another component of that, of course, is the tax treatment of the payments. Some deals, many deals, I'd say a majority of the deals we see are still treated as a current deduction as paid because we structure them as a consulting arrangement. There is an increasing use of goodwill in deals to try to make them a little more favorable for sellers, and I think that reflects situations where it's more of a seller's market, more of a willingness on the part of many buyers to try to find a way to get part of the deal at least treated as capital gain. And then, of course, the length of the payout period. So if we're going to pay out the remaining payments over 5 years versus 10 years, that'll have an impact as well. So the multiple is really the effect of all of those other terms. So if we have a large down payment, we have a short retention period, we have a practice that's going to not be as profitable as others might be, and we have a short payout period for the remaining terms, we would expect to have a much lower multiple than if everything else was the other way around. So in how do you use that to your advantage? Well, if you've got a seller that you're having difficulty with, your expectation is, gee, I should be paying this multiple and the seller wants more. If you play with the other terms, you might be able to justify a higher multiple by for instance, paying the payments over a longer period of time. So if I was unwilling to make a 5-year, say the seller was looking for 1.1 or 1.15, and you felt like, gee, I'd really like to get this, but I really have a problem with that. If you stretch the payments out over a longer period of time, say you go to 7 years instead of 5 years, you might be able to justify a higher multiple. In assessing the profitability of an acquired firm, let me just give you a really simple example. Say you've got a sole proprietor, and he's got a very small practice. He's working out of his home, and his wife answers the phone, and he has virtually no overhead. He's making a profit margin of, say, 80%. And all of a sudden he decides, you know what, I don't want to be working out of my home any longer. My wife is tired of answering the phone and answering the door. I'm going to move into an office. I'm going to hire a receptionist, and all those things cause his profit margin to go down to 40%. At what point in time was his practice worth more to you? When it was an 80% margin or a 40% margin? the obvious answer is that it doesn't make any difference. So the key thing is to understand how the cost structure is going to work in your hands as opposed to what it may have been historically. You know, in looking at the valuations in mergers, keep in mind that your owner agreement will basically define the value of the partners that you're merging in. I had a firm not too long ago that I worked with that for one reason or another, mostly because they wanted to lessen the strain that potential partner retirements would have financially on the firm, they adopted an owner agreement with a 1x multiple as their valuation. I told them, I said, we're going to have difficulty selling that in the marketplace. I mean, you know, it's going to be difficult for someone to say, gee, this is what my firm is worth, is 1x compensation. And as a result, we didn't get any deals done. And as it turns out, that firm actually eventually merged upstream. So keep in mind that your owner agreement is the currency that a firm that you acquire is going to use to determine their value. What are sellers looking for? Well, the first thing they're looking for, first thing they're concerned about is fear of uncertainty. You know, basically deals, particularly sales, are seller beware deals. There's very few deals that are done without contingencies. And those contingencies are basically pushing all the risk back onto the seller. You know, sellers tend to be control freaks. Contingent deals are scary to them. The most important thing for you to do is to create comfort that you're the right buyer, that you understand the risk that they're undertaking by selling to you, and you're going to do everything you can to help them minimize that risk and make the deal work for them. Most sellers are looking for hints that you're the wrong buyer. They're looking for things that you say that would indicate you're not interested in maximizing the value for their benefit. You know, they're also interested in maintaining income while they're still working. And it's important to understand the need for them to continue working with respect to transition. You know, some deals are done with them as immediate sales, no question about it. And many buyers like those because they minimize the amount of compensation they have to pay the seller. The problem with those kind of deals are that they put a lot of pressure on the client base because the seller tends not to be actively involved in the transition of the practice. So you end up very often with lower retention, client retention, in a deal that has an immediate sale where the seller is basically exiting in a short period of time. So many of the deals we're involved in tend to have a period of time during which the seller remains involved in the practice, oftentimes at least 2 years. So while they're working, while we're asking them to continue working full-time and actually add on some responsibility of going through the transition, they tend to think that they ought to get paid what they were making before, and that's the two-stage deal we'll talk about in detail a little bit later. You know, most sellers are concerned about cherry picking. In fact, I think most sellers assume you are going to be cherry picking their practice. So anything you can do to keep them from thinking that way and reinforce that's not your intention will help. And why do so many sellers want big down payments? Well, the first thing I hear is they want to make sure the buyer has skin in the game. So one of the things that helps is for them to understand that, go back to my example of the 30% of volume, most buyers are going to be investing that kind of money up front. That's significant skin in the game. Sellers also are trying to reduce the risk. They're not considering the quid pro quo of, you know, what a big down payment might make. So remember, again, the cause and effect of deal terms. You might say, gee, I can't afford to do the big down payment, but that's why I'm offering you this premium pricing in your deal. Or if I do give you a big down payment, we're going to have to find some way to reduce the cost elsewhere. What are mergees looking for? These are firms that are merging into your firm. The most important thing they're looking for is upside. Most of these partners are going to be investing the rest of their career with your firm. What's in it for them long term? Why is this better than continuing to do what I'm doing now? They're also looking for no out-of-pocket. I'll give you an example of that. I worked with a firm, this is about 5 years ago, that was being courted by one of the semi-national firms who had a policy in place that each new partner had to contribute $400,000 of capital. This particular firm only had about $200,000 of capital per partner, so each of the partners was actually going to be expected to pony up $200,000 to join this firm, and they'd asked me to do that. Why would I give them my practice and have to write a $200,000 check for the privilege of doing that? needless to say, the deal didn't go through. So avoiding that kind of out-of-pocket is important. Income certainty. This is the reason for 2-year conditional guarantees in many deals, compensation guarantees. What we're not protecting the seller or the mergee from economic uncertainty. I mean, if their practice lose clients or they quit working as hard, that should impact their compensation. What we're basically protecting them from is the uncertainty of however our partner compensation system is determined. But again, I think limiting it to 2 years is important. And most sellers are afraid of you becoming a boss that they've never had before. They're looking for a lack, not necessarily a lack of accountability, but they want to know how much more accountability are we going to have. With that, Gretchen, I'm going to turn it back to you for the next polling question.
Okay, this is our second polling question. And remember that you need to answer 3 of the 4 polling questions for your CPE credit. Our second question, is our current level of interest in M&A is, and your choices are, experienced and currently looking, no experience, actively looking, not sure but intrigued, or just not sure. We'll give you a few minutes here to get those answers in. Another few seconds. Okay, most everyone has answered. I'm going to go ahead and close this poll. And the answers are 43% experienced and currently looking, 25% no experience, actively looking, 18% not sure but intrigued, and 14% not sure.
Okay, well maybe after today you'll have a better understanding of whether you want to do this or not. There's 7, we're going to go over next the 7 steps in the process of conducting mergers and acquisitions, steps for the buyer. First is identifying target firms. There's basically 3 ways to do it. One is, and what we find is very effective. Of course, we think the best way is to hire us, but short of that is networking. And this is like recruiting experienced staff. It's basically a matter of keeping your eyes and ears open in your marketplace constantly for opportunities and indications of opportunity. And the other thing that I recommend is that you make it known your interest in this with people that potentially can refer you opportunities. This would be lawyers, bankers, and so forth who are talking to firms oftentimes about their future and would be in a position to let you know so-and-so is potentially interested in selling or merging their firm. We've also seen examples of this with insurance agents, malpractice insurance agents and so forth. So letting people know that you're in the market, you're actively looking. Any kind of networking you can do. The other is databases, building an understanding of who's in the market, as much information as you can about them and keeping that constant. Some of this information is public information. You can use a Dun & Bradstreet or somebody like that to identify firms and the size of the firms and who the contacts are and so forth in your marketplace, and just keeping a constant database. And then, of course, working with consultants like us, one of the things we do is find firms. We are in constant, in certain markets, we're in constant communication with the marketplace, mostly large markets. In smaller markets, we our search services on an as-needed basis. Your initial contact, you want to make it as easy as possible to have an initial meeting. I think it should be known that you have an interest potentially in talking about a potential merger, but don't make it really difficult to say you got to make them feel like they have to make a decision right away whether or not they want to do that. So more of an exploratory type meeting, unless you know for a fact that they are interested. Be prepared as soon as possible to provide this information to the firms you're talking to. These are the things that they generally want to know about you. The questions they ask me when we're talking to them about who they ought to be talking to. And then the things that you ought to get from them as soon as possible. And these are the things that we typically think are important to understand whether or not there's a fit between your firm and their firm and whether or not this is an opportunity you ought to pursue. We actually have a form, a standard form that we use to gather this data, and I would be happy to provide you a copy of the form if you'd like, and that leads to our next polling question. Gretchen?
Yes, and we kept this one pretty simple, so our question for number 3 is, please send me a copy of the practice summary sheet, yes or no? This is the third polling question. Well, this one's going pretty quick.
You don't have to go into, I don't think they care whether what percent says yes or no.
I'm going to go ahead and
we'll follow up. If you want one, we'll follow up with you.
Yep, give you back the screen there.
Okay. At your introductory meetings, this is what you should be prepared to talk about. Obviously, it depends on how you got into the meeting and how you set the meeting up as to how deeply you'll go into these issues. The most important thing, I think, is to share your business plan for the merger or acquisition. Keep in mind that you're basically an investment that every seller or mergee is making. So in the case, I know you look at it as you making the investment, but from their point of view, they're investing their whole practice, their whole career in you. And so your ability to articulate for them the business plan that you have for the merger or acquisition is important. I can't tell you how many times I've had a buyer talk to a seller we found for them. They have the first meeting and the seller tells me they don't know what they want to do. They don't know how they're going to replace me. They don't know how, they don't seem to have a good understanding of how they're going to run this practice. Sometimes we can overcome that with subsequent information. Sometimes that kills the deal right there. So being prepared going in with your business plan for the merger or acquisition, I think, is very key. You also want to try to find out, though, what the seller's motivations and desired objectives are. Why are they selling? What is it they want to accomplish? How long do they want to keep working? What's their personal goals and objectives? Because ideally, you're going to meet all of those goals and objectives with your plan. Find out as much as you can about the seller, because you're basically at this point conducting due diligence. It's a form of due diligence, but while you're still selling the benefits of joining your firm. So it's a combination of making sure that it's a two-way conversation. Keep in mind, you're selling your firm, the benefits of your firm, at the same time you're thinking about buying their firm. And your goal should be to have no more than 1 or 2 introductory meetings before you decide to proceed. It depends on the nature of the first meeting. If you're talking to a multiple partner firm and you're only talking to one partner in that firm, then needless to say, you're going to have more meetings with the other partners probably. But you should try to get to the meat of the matter as quickly as you can. I'll tell you that the best buyers, the buyers that are the most successful, are the ones that have the fewest number of meetings. The ones that we see that are the least successful are the ones that drag out the introductory meetings over months and months and months and meeting after meeting after meeting. Pretty soon you basically die from done deal or die from just the weight of having so many meetings and nothing really ever being accomplished. When you go, after you get to the point where you decide to make an offer with an acquisition, make sure your offer contains the following: a clear and specific description of the partner roles. Remember, an acquisition is a purchase, not a merger, and how the partners are going to be compensated. So how long are they going to stay with your firm? What's their role going to be, and how are you going to pay them while they're there? You want to make sure you describe the business plan for the combination. That would be, how are we going to deal with the office? Are we going to assume your lease? If we're, are we going to stay in that location long term? Or are we planning to move? Are you going to rename the practice? What's the name going to be operated under? How are you going to deal with staff? I mean, it may be an assumption. You may think, well, shouldn't they know we're going to hire all their staff? Well, not necessarily unless you say it. What resources are you going to employ with the practice? Are you going to move anybody into their offices and so forth? Make sure you're clear about the treatment of existing facilities, and also lay out what you see as the timing and remaining steps in the process. So set a target date and be aggressive. Keep in mind that time kills all deals. Your non-binding offer should also include, of course, the description of the deal terms. So what's the pricing? What's the multiple going to be if that's how you're pricing it? What's the retention adjustment? How long will that apply, and how will it be applied? The treatment of new business. Will there be a new business bonus for bringing in business, or will you allow them to use replacement clients to keep the purchase price intact for a period of time? What's the tax treatment of the payments going to be? Will it be consulting and therefore deductible, or an asset deal, therefore making it subject to capital gains? And how will you treat accounts receivable, work in process, and furniture and fixtures? We're seeing increasing use of a technique of delaying the payout of AR and WIP until maybe a year or two down the road in order to allow the buying firms to use that working capital to work off of initially. What's the difference between an LOI and an offer letter? An LOI is a legal document that generally includes obligations on both parties, from both parties to certain things. For instance, exclusivity, will no longer be negotiating with anybody else. An offer letter is more of an informal approach. We typically use an offer letter to start things off because it keeps the lawyers, and I hope there's no lawyers on the call if there are, no offense intended, keeps the lawyers out of the process for a little bit longer until we get to an agreement, at least a verbal agreement. Once we start introducing lawyers, we introduce people that potentially can become adversaries for the deal. Now, once we've got an agreement, there's nothing wrong with going to an LOI short of the final contracts. But I think it's better to have the terms agreed to, the general terms agreed to, before we actually start asking anybody to sign anything. So that's where we believe that non-binding offer letters are better. With respect to mergers, your owner agreement is obviously a key component to this. We suggest that you start off with describing the salient points and not give away the original agreement, because the agreements can be very complicated and hard to understand. So describe what it means for the merging partners first, defining what equity means and determining what how it's going to be determined. Make sure you're clear about describing compensation issues, how much capital they're going to be required to contribute, if any. Try to make it easier for them to do this. In other words, try to use their existing assets as their capital contribution and take into account the fact that there may be some tax ramifications. This is, again, avoiding asking them to come out of pocket. Describe the business plan for the combined entity, and as I said before, make sure you're describing what the upside opportunity is. Due diligence, when to conduct it. Now, as I said before, you're actually doing due diligence in the first meeting. What we're talking about here is field due diligence, things like going through work papers, going through personnel files, reviewing leases. We see all too often acquiring firms trying to do this before they ever get to deal terms. And we think that it's actually, that's way too soon. It's invasive, it takes time. Sellers tend to resist that. It's better to get to your agreement terms first and then go through all those things like, work paper. And I'm not saying you couldn't find something in the work papers that would cause you not to do the deal, but it's probably not going to change the deal you do. So, you find out it's a schlocky firm and they do bad work, don't do the deal. The fact that you agreed to terms prior to that problem, that's not going to happen very often. And then tips on agreements. Make sure that this is the final agreements. Make sure that you don't let your lawyer use the agreement to negotiate new terms. The terms you've agreed to in the LOI or the non-binding offer letters should be remain intact in your final agreements. What defines a good merger or acquisition? Well, of course, you want to achieve your strategic goals, but you probably will never think you've done that if you don't have high retention of clients and staff. So keep in mind that those are affected by the continuity, behind the door and in front of the door issues. Behind the door are things that the clients aren't aware of, things like the tax system that you use, the processes you use to produce work, your policies and procedures. Things that are in front are the things that clients are going to impact the clients. Those are the things that you want to focus on and try to maintain as much continuity up front as you can. What are the 5 questions every client asks? First, will this cost me more? Will the services change? Will the manner I'm being served change? and who will be doing the work for me? And the fifth question many clients will ask of the person they're having this initial conversation with is this a good deal for you? So when you design your communication with clients about what's been done, keep in mind that you want to address those 5 questions, or at least the first 4, and be prepared to have the fifth, conversation about the fifth. The best way to do this is to create a script for each person to use in defining the questions. We'll get into our last polling question now, Gretchen. We're running just a little bit late here.
Okay, this is our 4th and final question. What issues do you see affecting your practice most next year? Your choices are succession for retiring partners, admitting new partners, client retention for retiring partners, and need for growth. Most everyone's in. We'll give it a few more seconds. Okay, we'll go ahead and close this last question. And 63% say need for growth, 15% each for succession for retiring partners and admitting new partners, and only 7% for client retention for retiring partners.
Okay, very good. Okay, so I don't really have time to go detail into 2-stage deals. I'm going to refer you to our website. There are probably 3 articles on our website you can download about 2-stage deals, and it's a technique we use frequently in our deals. We think it fits a lot of situations, and if you want more information about those, I suggest you look at those articles. Finally, the 4 C's: chemistry, capacity, continuity, and culture. You know, chemistry is the likability of the parties involved. Our rule of thumb is if you don't like having, if you can't imagine yourself having lunch on a regular basis with a person sitting across the table from you, you probably shouldn't do a deal with them. Capacity is a big issue for sellers. You know, how are you going to replace the seller? You know, who's going to do it? Is this somebody you have on board now or somebody you're going to have to hire? I mean, how's this going to work? Because your inability to provide the capacity to replace them will obviously impact client retention and therefore their deal. Continuity, minimizing change. I think sellers don't want to have, the more things you talk about changing, the more scary the deal becomes. And I'm not suggesting you don't have to, you shouldn't be executing your business plan, but as you're communicating this to sellers, keep in mind that you want to emphasize what's going to stay the same as opposed to the things that are going to change. In culture, I like to define as what's it like to be a client in this firm, a partner in this firm, and a staff person in this firm. When you deal with partner culture, when you're dealing with a sale as opposed to a merger, it's not as important. Partner culture is not as important because they're not long-term. But the client issues and the staff issues probably are. Some suggested reading. We wrote a series of articles for the Journal of Accountancy between July 2013 and June of 2014, 12 consecutive months that you can download from our website on succession issues, which includes everything having to do with mergers and acquisitions and owner agreements. That was followed up by another series of 3 articles from October 2014 to December 2014 strictly on the issues of valuing an accounting firm, small firms, large firms, and internally. Another article within these 2 series that are specific to what we talked about today are the culture test and how to maximize client retention after a merger. So if you want more information, I suggest you do that. I also would direct you to the AICPA Succession Planning Resource Center. We had a part in building this for them. We're not solely that, but there's a whole lot of information in there about succession positions. Finally, I'm a member of the CPA Consultants Alliance, and there's a lot of information on our website, the Consultant Alliance website, about issues that affect accounting firms today. These are the other members of the Alliance. We just wrote a book that you can buy through Amazon called Bridging the Gap, Strengthening the Connection Between Current Emerging Leaders in the CPA Profession, and then we've issued 3 white papers over the last 3 years on these issues. With that, I'll turn it back to Gretchen, and thank you for your time today. I'm sorry I'm 5 minutes late.
Okay, well that wraps up our webinar for today. You can get a hard presentation by making a request via email to Nikki, the Marketing Director at Transition Advisors. You can reply to any of the emails sent by GoToWebinar, or her address is right below on the screen there. And we just hope you have a great day. Thank you for attending our webinar.